Market watcher Eddie Ghabour is here. Well, the good news is, Eddie, that we didn't lose everything we gained yesterday, but it's pretty flat today. It still looks like investors are waiting for some direction, whether it's from the Fed or from these earnings or from the jobs number. What do you think?
Yeah, I agree. I mean, I think the market's going to wait to see what earnings look like this week. But ultimately, when you look at the setup, and I hate being this bearish, but there's really not a lot of good reasons to buy risk heading into this economic slowdown that we're going to see going into the next 2 quarters. And the Fed has already told you what they're going to do.
Right.
So, for me, it's a risk-off environment. We've been saying that since November. And I would take big rallies and look to reduce risk if you're taking too much risk exposure, because second quarter, in my opinion, is really going to be we're extremely problematic. Well,
and problematic, of course, that's kind of a non-committal term, but it still could go either way. I think I ask people what they're doing, whether they're going to invest in the slump of the market or whether they're going to get out at a top like yesterday. They say we're going to wait until see how the market reacts to that first rate hike. The first rate hike, which is going to be sometime in March, I think, is basically going to tell you how the market will weather these rate hike storms. No?
It will, but I think the market will sell off before you get to that rate hike,
Sure.
right? The market is going to be forward-looking. And I think the other component to that is how much lower does GDP get? You know, we were celebrating the fourth quarter looked really strong at 6.9. I think it decelerates quite a bit over the next 2 quarters. So when you put that on top of the inflationary pressure, on top of the Fed, there's more than just the Fed that's causing this bearish tone coming out of my voice. So to be more direct, we think the market is heading lower, much lower potentially over the next 2 quarters.
Now, how is the market going to react to economic news, whether good or bad? We got the jobs number coming out. By the way, we have job numbers, or at least the numbers of unfilled jobs, which had been up close to 12 million unfilled jobs. That's come down about 1 million. Is that good news or bad news? Because it could be bad news in that a lot of companies just figured they could do without the workers that they were hoping to get.
Well, we may get into a scenario in the summer months where bad economic news is actually good for the market, because that may put the brakes on the Fed raising rates. I'm in the camp that I don't think the Fed is going to be able to raise rates 4 times or 5 times like many people are predicting, because I don't think the market can handle it. The bond market is telling you that, and the economic data, I think, is going to really reflect that. If they get too aggressive, they're going to drive us right into a recession, and they don't want that.
Of course, if they don't get too aggressive, we may get double-digit inflation in short time.
Well, that's the problem that they've put themselves into, which is why we're in an unprecedented time period. And I don't want to get in front of that freight train and try to guess one way or another. I'd rather play it safe.
It's always problematic to get in front of a freight train. I've noticed that. Eddie Ghabour, good to see you, my friend. Thank you.